Hey everybody, sorry. This is just a quick recording. It's not an official episode or anything. You guys can probably hear my mouth is a little messed up. So, I just want to give you guys kind of your first homework strategy. And again, I don't care about the results of the trades being net positive. I just want to see you guys are able to identify them, work through the checklist in sequence, and execute from start to finish. So if you can do that 10 times in a row, um, you'll have a good set of data at least to work with. And again, regardless of the net P&L, this isn't like a super profitable strategy. I'm just showing you guys like the process. Okay. So the first thing you're going to want to do, and I'm just going to go ahead and combine these charts into one because this is exactly what I want you guys to do. So just going to go to the daily chart, and we're just going to have the daily time frame. You can ignore, I just bought JetBlue, but you can ignore the positions and stuff. Actually, let me just log out of that. Or I'll just lock it so you guys don't get distracted. Okay, so I'm on the daily chart. I just have any random ticker. I don't care what tickers you guys use. I want you to do just the daily chart. I don't want to deal with extended hour stuff. I don't want to deal with different time frames. That's all going to be separate teaching moments. So we'll just start with the daily. And you can even ignore that it's a daily chart if you want. It's just a chart that we all are going to use the same, and it's a nice clean default standard time frame across almost all tickers. So it'll be pretty good for practice. So daily time frame, all I'm going to do here is just going to go to indicators. If you don't see MA up here, we're just going to use the simple moving average. Just go to the main chart category and come down here to MA, that's moving average. And then you're going to go into your settings and change one of these to 20 if it's not already. And then you're just going to enable this checkbox. You can disable all these. We don't really care about anything else other than the 20 MA for this. And then all we're going to do is just put a very simple strategy in place. And to do that, we're going to build a set of rules. So let me just put this over here so you guys can kind of see it. I already kind of typed it out very quickly as you guys are chatting in the group there. So we got our daily chart, no extended hours or lower time frames. We got our 20 MA. The entry price. Okay, so this is when the candle's forming and you're going to execute the trade in real time. You're going to look for where that specific entry would be, and I'm going to tell you exactly what I'm looking for that. Okay, because you're not going to hit that button until you see everything else on this checklist ready. So entry price has to be above the 20 period moving average. So in this case, we don't want to place an entry down here. Okay, this is below the level. We don't want to buy anything below this green line or whatever your color is. Okay, it doesn't make sense to buy stuff below average if we're not trying to catch a reversal. This is just a purely directional bias trade. We're not looking again for like super hardcore high win rates and stuff. We're just using a filter. Okay, so the filter here is that you're not going to buy anything below this green line. Okay, that's it. Simple. Now, when it comes to the actual buy, what we're going to look for is we're going to use the moving average as another filter. So price has to be above the 20 period moving average. It's got to be above this line. And we also want to add in that the moving average, the line, needs to have a positive slope. Okay? And what I mean by this is if you look right here at this number, as I move my mouse horizontal, you'll see this number will change, right, as I go between periods. And that number here on the right, the 4.55 right here, that is the value of the plot of the average of the last 20 candles closing prices. Okay, that's what the 20 MA is for those who don't know. And all we're going to do is make sure that if I look at two candles, like if I'm looking at these two candles, well, that's three, but you get the idea. These two candles right here, if I'm just looking at the moving average values at those two, we can see they're the same. They're 4.16. If I go back one, it's 4.16 as well. If I go back one, it's 4.16. So I picked a bad sequence here, but these are all equal, right? This is a flat line. It doesn't have a slope. Okay, so now if I start to go forward, we go from 4.16 up to 4.17. Okay, so that's a positive slope. So this would count. Now you got to keep in mind that as this candle forms, the MA might be lower because really what caused this was the price pushing up and then that increased the moving average because this displaced the average over the last 20 candles. So this may or may not be where you would have actually entered and stuff because it didn't really move up as it crossed over this line. So we'll get to that next step here in a second. But you guys understand, like we want a line like this, okay? And if it's the first line right here, that's okay, right? You might not enter on that specific candle, but that's what we want. Like this is where we can start looking for entry. And let's see here, 5.47, 5.48. So the line keeps going positive until we get to right here, okay? So this is going to be where I look for trade opportunities, right in this little box, okay? Because every single green line, every single moving average plot point here has a positive slope. So that enables me to move down to the next step on my checklist. And the next step here means that we need to see a red candle at or just above the 20-period moving average, okay? So in this case, we kind of get this guy, right? It's near the moving average. If I look back historically, it's kind of within range of all the other stuff that's just kind of clumped up around the moving average, so I can use this. If it's too far away, like if it's this or this, there's such a gap right here between that and the line, you're not going to be able to use that effectively. Like you can, but that's some serious strength and you might just pass that one. So it's usually safer just to look for stuff that's near the moving average. But again, just for the sake of doing this as homework, I really don't care personally. You're just probably going to get more frequent stop outs. So for the strategy, let's just keep it a rule that you want to have the you're gonna have your own discretion in there, but just make sure it's kind of near the moving average. You don't want to do something that's super overextended, unless you want to practice your stop loss. That's okay too. All right, so basically what we're doing is we're using this as a filter, right? Because we don't want to buy red candles. We want to wait until they're done, and then we want to wait until there's a color change in the opposite direction, showing that the buyers have overpowered that last bastion of where the bears had their grubby little hooks into our trade. So we're not going to buy red candles. We're not going to buy stuff that's below the moving average. We're not going to buy stuff when the moving average is descending, right? Because the average price is dropping, so there's no reason for us to jump in unless we're trying to trade reversals specifically, but that's not this exercise. This exercise is just to catch stuff on the way up, right? During a pullback, you catch it as it resumes. All right, so just to recap really quick. Daily time frame, 20-period moving average, entry price itself. So while the candle's still forming, you're going to look for that entry. It's got to be above the 20-period moving average, so no buying below it. 20-period must have a positive slope, and we're going to look to kind of narrow this down to around where red candles are. So first thing we need is a red candle, right? Because we can't do anything color change-wise without that initial red candle, okay? The entry threshold is going to be right over the top of that body of that red candle. So this one is good, right? This fits our criteria. It's a red candle. MA has a positive slope. We're above that. And we have a color change right here. Sorry about that. I had to stop the recording for a moment. Okay, so yeah, just recapping really quick. We got our target candle right here. The first thing that we're going to look for is this red candle above the moving average with a positive slope on the daily time frame, just kind of really driving that home. So the opening price, or the entry threshold, is going to be the opening price of this candle. So if I look up here at the OHLC, this OHLC, the O, right, it says 415. H is, oh, it's going to move as I move my mouse because that's these candles. But for this guy, the opening price, if you look right up here at the O, you can see the opening price of 446, okay? So if I draw a line, and I put it to the cent at 446, that's my entry threshold, okay? Now, so far, this passes our criteria, all right? And the next step is going to be to identify where our stop loss would go. And that is, again, something you can do before you enter the trade, is you can look and see where your stop loss would be. So in this case, the stop loss is going to be the lower of the two participating candles. So in this case, this is a candle and this is a candle. I hate the vertical crosshair thing because it covers up the line. But you guys can see if I just draw a red line, and you can use the L over here. So that's this L right here. That is going to be 433. So if I put this line down here at the bottom, if this candle had a lower low, it would go there, but this is the lower of these two. So I put the L right there, the stop loss. So this identifies my entry threshold and my stop loss. So this gap between the two lines is my risk range. Okay, so all I have to do is draw a line, or I'm sorry, a rectangle, and that tells me it's a 13-cent risk, so I double that to the upside, and 26 cents, and I can draw another level, and that is my take profit. Right, so hopefully that makes sense. All I did is I identified the engulf threshold, the trigger, right? Then I identified the stop loss, which is the lower of these two candles, and then I doubled that range, my risk range, for my profit range, and that's my target. Okay, now this is a very simple strategy. We're not focused on, how high it goes, because it will do that, right? And that's the concept behind this, is you're just catching it as it goes. You don't know how high it's going to go, so while we're just practicing this stuff, just lock in those profits, okay? And again, I don't want anyone to do this on real accounts. I just want people to practice this on a paper account or just do a chart like I am. So we've identified the risk range. We've identified the take profit, and we're just going to use a 1 to 2 risk reward for right now. But at that take profit range, we're going to sell 75% of the position, okay? And what that does is it locks it in. It guarantees a net profit, because the remaining 25% would have to go 3 times this distance below our entry in order for us to lose that same profit that we just secured. Okay, so it's a little bit of a weird math situation, but promise, I've done the math. So anyway, we guarantee ourselves a net profit, and in this case, we'd have 25% left. So what we can do there is we can move our stop loss, this original stop loss down here at 433, which is the lower of these two candles. every time we see a validated higher low form, in this case the only one that we have is right here. So for a validated higher low, we need a candle, a candle, a candle, and then we need another candle and another candle. So every validation is a 5 candle sequence, okay? And in this case, the validated low is this guy because it's the 2 candles to the left, 2 candles to the right are higher than the low of this candle. So we need these 5 candles to appear in this sequence, or some variation of it. I mean, it might be, you know, it might be up here, this one might be up here, this one might be kind of like close to this guy, you know, it might not always be perfect, but so in this case, this might look like a higher low, but it's not, because this one here invalidates that, because it's 2 candles to the left and this one's lower. So this isn't a validated higher low. This one here is, because if we look at this candle and we go 2 candles to the left, 2 candles to the right, this one here is a validated higher low. So when this candle forms, we're not going to know that. Okay, we're going to know that when this candle here closes, because this is the validating candle for that, because remember, we need 2 candles to the right. Okay, so what we can do when this candle forms and then this candle forms and it validates, we can move our stop loss up to this guy. Okay, and the remaining 25% of our shares. Let me just erase all these. So at this point, okay, if price falls back down, we're guaranteed a net profit, which is more than we already planned, right? And then we got another a validated higher low right here. So this candle forms, we don't know that's the higher low yet until this candle closes. This validates this higher low, so we can move our stop loss up then. Okay, and then this guy right here isn't a validated low because this invalidates it right here. Okay, so in this case, the price just kind of came back and hit our stop loss. Now we don't have a 5 candle run here, so we can't use that either. Okay, but if we did see a 5 candle run, that you just move your stop loss up below each subsequent candle. So for those who aren't familiar with that, let me see if I can find an example here really fast. Okay, so if you look at all 5 of these candles right here, for example, we'll just move this down here. Let's just say that our stop loss is way down here somewhere. Or no, we'll use this, right? Because this is a validated higher low. All right. So 1 candle, 2 candle, 3 candle, 4 candle, 5 candle. All 5 of these candles right here have higher lows, and you can tell by the wicks. The bottoms of the wicks are always higher. So at this point, when this candle here forms and closes, that becomes the stop loss, right? And that's how you catch the end of an impulse. Now, in this case, it just happened to continue, at which point you could have just got back in, right? Because it's an engulf. And same here, it's a color change off the moving average, and beautiful, right? But this is a 5 candle run right here. So you would have entered right here on the breach of this red candle because it's close to the moving average. All right, your stop loss would be right here, the lower of these, you know, series of candles that do the color change. And then you had 1, 2, 3, 4, 5, 6 candles in a row. So every time, like when this 5th candle here closed, your stop loss moves up, and then every subsequent candle after that with a higher low gets the stop loss moved up on top of that. And you can see the potential there is insane for you to catch the tops of those runs. And you get the same thing here on this guy. It happens to be the same level, but it just works out really nice. So you can see that every single situation where we have one of these guys, you know, it's not always a winner. Okay, so like this is a red candle, this is a red candle, it's near the MA, it's got a positive slope, it fits our criteria, and this is why I want you guys to practice this, not for the results, but for the process, okay? Because what you're going to notice is that if you're entering here and you're stopping here, that is negligible for a loss. But you've got this upside potential, and this is a process you can repeat mechanically, so you don't need emotions for it. You know, same thing here. Maybe this wick is a little bit more, because you'd enter on this candle, but maybe this risk here is a little bit bigger than you wanted, but look at the profit potential on that. Maybe you can just pass this trade altogether. Maybe you enter somewhere else. Maybe you don't enter at all. It's okay, and that's the beautiful part of this. So I don't want to go too far down the rabbit hole because I have to end this recording and get upstairs, but there's 2 take profit scenarios, right? The first one, either it falls down and hits your stop, or it hits the 2 times target, okay? In which case you sell 75% if it's the profitable scenario, or you lock in 100% if it's a stop loss, okay? And then beyond that, if the first target's hit and it keeps going, then you look for 5 candle sequences, higher lows that validate, and then you just move those stop losses up until it hits the stop loss, or you see a 5 candle run, and then you just lock those last profits, okay? Hopefully that makes sense. I know I kind of ran through this, but I'm not going to be able to talk tomorrow, and it's easier to do a video here than it is to try to write all this stuff out, because I will flood that chat. You guys know it. All right, so I'm going to put this on YouTube, and then we will, I'll touch base with you guys tomorrow if I can get online. I'm going to be pretty out of it tomorrow, or just not wanting to focus on, you know, computer stuff. So with that said, I appreciate you guys all watching, and I will catch you guys tomorrow. Thanks, bye.